Hello and welcome to the investment presentation for Frankford Station Lofts. We are super excited about this new purchase. This is a brand new property. It is still in lease up. It was completed in September 2020. So just a few months ago it was completed. They started doing the lease up. Their lease up has been going slow with management challenges, things like that. So we are buying the property, and not only that, we took over management of this property over a week ago. So we are going to manage this property for 2 months before we actually close on it, which gives us a huge opportunity to get in there and lease up as many units as possible, take control of the property, start creating value now before we even buy it. So I'm going to go through the investment presentation here. Again, this is Frankford Station Lofts, and it's called Frankford Station Lofts because right across the street is a major hub for the DART rail and DART station. So we've got quick transportation, public transportation, basically across the street. Right behind it is a golf course, and just to the west is I-35. So this is I-35 and Frankford Road. And you can see in this picture that there's actually a signal here on the entrance to our property. So it's a signalized intersection to go right into our office. Brand new construction, 4 stories, beautiful Class A property. You are going to love it. So let's get into the nitty-gritty of the details here. Frankford Station Loft is at 1700 West Frankford Road. We're paying $37 million for it. Now that's $181,000 per unit, which I still think is below market. Class A stuff like this, leased up, that should probably be worth $42 million or so. So we're buying it about $5 million under what I think it should be worth once it's stabilized, but it's just not stabilized. So this is a brand new value add property, new construction, and we took over maintenance, and we've still got a builder's warranty, which is nice. Now I want to point out 2 things. Well, first thing is the projected return for the partners is projected at 19% average per year. So a spectacular projection on this. We are getting an acquisition fee, and we are sponsors keeping 14%, and guarantors get 6% because they are guaranteeing a $32 million loan. So this is a great deal. We'll be all in at $40 million, which is $196,000 a unit. Now, I want to point out something right here. Lender reserves. We've got $900,000 that the lender is going to be holding back in reserves because technically when we buy it, we will still be negative cash flow. Now, remember that there's $900,000 in lender reserves in our total capital raise to take care of negative cash flow. That's going to come in later on something you'll find pretty exciting. Current unit mix. 1 2-bedroom units, primarily 1-bedroom units. They're all brand new, great floor plans, 10-foot ceilings, beautiful granite countertops, stainless steel appliances. If you haven't watched the drone video and video that we did, take a look at that right away because that will show you how beautiful this property is. The average unit size is 817 square feet with $1,378 effective rents right now. Now that's the rents that they're getting right now. We're projecting $1,462. So they're still a little bit below because they have lease up specials right now, which is dragging down that overall average rent. But still, $1.79 per square foot on our projected rents for new Class A construction, I think is a good deal. Now, this is the unit mix. Now, there's also rentals. There's a bunch of storage units, a bunch of garages, and a bunch of carports. The number I didn't even include in here, but the income from that I have included in our other income numbers. Now, again, 204 units built in 2020. It's got pitched and TPO roofs, individual electric, individual HVAC, individual hot water, A-plus property, 4 stories, brick and siding with a slab foundation. We don't have anything in improvement budget because it is brand new. There's nothing we need to do to it, and it's still under a builder's warranty. Here's what my numbers look like. Okay, as always, I do what the current owner is providing. Now, that's kind of an annualized number based on the last few months as far as their income and expense. So you can see their vacancy and collection loss is 60% right now. When I did this, their average was 40% vacant. Now they're, I'm sorry, let me rephrase. They were 40% occupied at the time of doing this analysis. And as we go ahead, every day we're leasing more units, so that's going to get better. I put in here what my pro forma is, and with these numbers, with 10% vacancy and collection loss, $220,000 in other income, which I think is low based on all the garages and carports. But we put something in there, and so I didn't want to go too high above that number. So we've got also minimum assumptions. If I screw it up, what does it look like? And if I am very low on my assumptions, what does that look like? So I'm budgeting stabilized with the current situation where the property is. If it was stabilized with 10% vacancy, I'm projecting $1,953,000 in NOI. Now, if I screw up, it could be $1.5 million. If I do really good, it could be $2.1 million. So we'll see how that happens. We've got company expenses and reserves. We're still putting into reserves every year. Debt service, we've got an interest-only bridge loan. Now, it's a 5-year bridge. It's actually 3 years plus 2 one-year options, giving us the ability to go out 5 years. Now, I'm budgeting doing a refinance in year 3. We'll probably do that sooner. Okay? And we have that right over here, the refinance in year 3. So we take the sponsor pro forma, and then I take and I move those numbers over here to our 5-year projection. We're only budgeting a 3% rent increase. It could be more. We're budgeting 3% rent increase, 2% increase. Now, I'm using an average of 19% collection loss. Okay, that plus a 6% vacancy loss. So I'm budgeting 25% income loss in year 1. Now, when I look at my 12-month budget, it's better than that. But again, I want to be conservative about what we're doing. Income, $2,904,000. Our expenses, $1,472,000. So NOI of $1,422,000. We'll have company expenses, $65,000, reserves, and our debt. So we're showing a loss of $39,000 in year 1 with a 25% vacancy and collection loss. Now, I'm going to take a minute. I did something a little bit different on this investment presentation that I want to show you. Let's go out and look at what the lease up of this property looks like. So the lender wants to know, what does our monthly budget look like during this lease up? So that's what I did here. Now, we took over management in March with occupancy at 42.2. We're planning on, between March and April, leasing 10 units to take our occupancy to 47.1%. Now, if you remember, I also have $1,300 just for this calculation, an average of $1,300 a month in rent. Now, again, I wanted to sandbag this quite a bit, and I'd rather under promise and over deliver. And so I plugged in $1,300 on rental income and not having that average go up until September after our leasing season, May, June, and July. So our occupancy is going up. So by the time we buy it, it should be about 50%, between 47 and 54% occupied. And that negative cash flow, the first 2 months, that's absorbed by the seller because it's the seller's property. When we take over in May, I'm budgeting 10 new leases in April, 15 new leases in May. Lease units 111, and all this really is coming down 111. That's 54% occupied. Average rent of $1,300. Multiply the 111 lease units by 1,300, gives you 144,000. Other income, I have been slowly moving up based on new residents. Total income 160,000, expenses of 122, NOI of 38, other expenses at 3,600, debt service 112. So in May, we're projected losing $78,000. But remember I said that the lender has lender reserves in there of $900,000. So we can draw against that for negative cash flow of the operations of the property if the cash flow was too low, or to help cover on debt. Either or, we can use it for operating expenses if we don't have enough, or we can use it for debt, or both. But we have $900,000 sitting there. My numbers for leasing up: 10 leases in April, 15 in May, 20 in June, 20 in July, 20 in August, 15 in September, and 5 in October. And at that point in time, we'll be 93% occupied. These numbers have actually been dumbed down quite a bit from what our management company says that they can do. Again, under promise, over deliver. So if we can do this faster, then we'll be better off. But I want to be realistic, because our leasing season is really May to September. So we want to make sure that we get a lot of those leases done in that time frame. Like I said, we'll lose money for the first 3 months. What does that look like, though? Negative cash flow from operations. We're just going to have these 3 numbers here, which totals $143,000. But we'll still have $756,000 in that operating reserve account. That's our money that we can draw on. Now, that extra $750,000 is set aside as lender reserves. It is not added back into our cash flow numbers anywhere. So if we get through and we're stabilized in this and we're making cash flow and don't need to draw on that, eventually we'll be able to get that $756,000 back. That is extra cash flow that will be distributed to the entire entity that is not included. That's an extra $750,000. Now let me show you something else. These numbers, the first year, going from May to April, has a total value. If I take all those numbers, add them up, our NOI is $1,705,000. Now, $1,705,000, that's because the NOI up here was only 38, 67, 96, 125, 165 up here on top. $1,705,000 would be NOI. The value at a 4 cap, which on a Class A, I would imagine we could probably sell at a 4 cap or have a valuation of $42 million. Now, if I take the NOI of 173 stabilized, say our T3, 173,000 times 12 divided by a 4 cap actually says the property is worth $52 million. Now, put this back in other terms. $42 million says $209 a unit. Stabilized, $254,000 per unit. Okay, so now remember those are going to tie back somewhere else. Well, actually, those will not tie back anywhere because these are very aggressive numbers, realistic but aggressive, more aggressive than I actually want to commit to. So now we'll go through. Again, this is what our 12-month budget is. We'll lose money for the first 3 months. but then we'll be making money after that. I'm going to go back to the 5-year. In my 5-year, I'm showing that we're going to do a refinance in year 3. Now, my refinance value in year 3, of course, it's not $1.7 million on the NOI. Now it's $2,174,000. If I plug this in at a 4.7 cap, okay, and the way that I'm looking at that is starting at a 4.5, 4.6 year 2, 4.7 year 3, 4.8 year 4, 4.9 year 5. So I'm taking the current cap rate, which I'm estimating high on a Class A property at 4.5 and still bumping it up 10 basis points. Bottom line, I'm showing a value in year 3 at $46 million. Refi, 70% cash out refi with Fannie Mae or Freddie Mac. 2 points to refinance that. Half of that is an exit fee to the lender because it's a bridge loan. Pay off the existing loan, and we would have $605,000 in proceeds to distribute. Now, $605,000 in proceeds to distribute. I did not include anywhere in there the extra $750 that we might have to distribute, not even included. So $605 to distribute in year 3. So let's take a look and see what this looks like for partners. Here's our projection. This is what the property is going to do. These numbers match up to our 5-year performance. A $100,000 partner can expect $4,000 year 1, which is 4.1%. $4,500 year 2, 4.5%. $6,600 year 3 in cash flow from the properties, plus that refinance amount out of that $600,000, a $100,000 partner would get about $6,000, $5,862 back. So this does not include, again, those amounts in reserve that might be returned in year 1 or year 2. Okay? So that could add it pretty dramatically. Let me see if my spreadsheet will do this. Year 4, because our payment's actually going down and our income's still going up, we'll have higher cash flow, 9.5. In year 5, 10,000, and we're projecting a year 5 sale. It could be 3 years, could be 7 years, could be never. But we're projecting a 5-year sale, and investors, after they get all of this money already back, they're also getting the cash flow and $154,000 back. That gives a total return of 19% average per year, a 1.95 multiplier on conservative numbers. Now, let's just say in year 2 that because that's $700,000, what would come back to that? Let's just say that that's $6,800 that would go back to the partners there. Well, now we're looking at a 20% return by just adding back in that amount that I didn't even include, that $700,000 in our reserve account. But that would be 20% per year, 101% overall average return over 5 years. Take that back out. Now let's show you something else that could make you excited. Let's see. Value to cap rate. Again, it's a 4.9% cap rate right now. And we are projecting, I'm going to make this screen a little bit longer, a 19% per year average return at a 4.9 cap in 5 years. When the cap rate scale, it's a 4.5 cap rate. Well, now we're looking at a 27% per year average return. So pretty dramatic on that. On the flip side, if it's a 5.5% cap rate, the return goes down to 9.2, but there is no way that that's only going to be worth $42 million would be $208,000 per unit. So there is no way that it's going to be that low in value because we're pretty conservative on all our other numbers. So there's no way that it's only going to be that. Okay. 4.7 cap rate would be 22.9. 4.9, which is the projection, 19% average annual return. Now, 19% average annual return with conservative numbers on income expense and not even taking the extra $700,000 we can get back. I'm projecting a 19% return for a Class A property in the middle of DFW. So this is a spectacular deal. We would love to have you involved. And again, that's showing $233,000 in value in 5 years. I am sure, I am positive we will be higher than $233,000 in 5 years in value. So I really think our value right now, once we get it stabilized, is closer to that $42 million mark right after we get it stabilized. So within a year, adding $4 million in value to the property. So those are the numbers that I came up with, and our projections. Like I said, we're already on site managing the property. We're going to try and lease this up faster so that these numbers can go faster out of the red and into the black, so we can have better projections or better numbers overall if we can beat our projections that are these numbers. So I think this is a spectacular deal. It is absolutely awesome. Class A property in Carrollton, Texas, with a projected return of 19% per year. So pretty dang spectacular. So let's see if we have any questions.
Darwin, we do have a couple of them. One question was, what is the minimum investment I can put into this deal?
Okay, two different things on this. First off, this is a 506C, so this will be for accredited investors only. And the minimum investment on this is $100,000. And so the minimum investment is $100,000. It's a 19% projected average annual return. Class C members, accredited investors only. Now, or not, get Julian or Garrett a call, or Jeremy, and they can advise you on whether or not you are accredited. And that's always fun. They always say, how do I become accredited? It has to do with your financial situation, so reach out to them and they can explain it better. What other questions?
The fact that it's for accredited investors answers another question. There's a third question, and can I use my IRA?
Yes, you can use your IRA to invest. Now, we need all the funds in by mid-April for a closing in late April. So if you're going to be using IRA funds, you need to get on that right away. It takes a few weeks to get everything moved over to a self-directed IRA if you don't already have that set up. So if you don't have it set up, you can reach out and get some referrals from our team, and they can tell you a couple of good places to go to set up a self-directed IRA. But if you already have it set up, it's a quick and easy process with the PPM directly to your administrator.
Those were the three questions that I have gotten thus far.
Okay, good. Any other comments or questions we want to throw in here? Again, beautiful property, brand new, 4 stories, frontage on Frankford Road, Frankford and I-35, right down the street from a major DART rail station, so they can go right out there, go right down the street and take DART rail right downtown. Once this whole thing opens up from COVID, they'll be riding DART again. And we are in lease up, and we've already taken over management, and this is a great deal. Everybody's going to want to be in on this one. And so love to have you. So reach out to our investor relations team, and they can get you hooked up. So thank you, everybody, for listening in. And that is our investment presentation for Frankford Station Lofts. You can get the full information in your private placement memorandum, subscribe with the subscription agreement, and get all that through our investor relations team, who will get you hooked up so that you can invest in this Class A property with projected returns of 19% per year average return. Thank you so much. We'd love to have you as a partner. Have a great day.